Trump's latest move won't stop the liquidity crisis. I'm Steve Van Metre. As tariff scramble can't fix the cash draining from markets, chaos is brewing, and you won't believe what the experts are saying is coming next week. Now, let's head over to JP Morgan where we find out what's clogging the plumbing of the financial system and why they say it could get worse. As JP Morgan responds to the Fed, there is a liquidity crisis and it's happening right now. With the yen, euro, and Canadian dollar strengthening at the same time, this could be foreigners selling U.S. treasuries, but the problem is we won't know for a couple of months because the data about where foreign treasuries are held, well, it comes out with a lag. But this isn't what's really going on in the financial system. It may be that there are foreign institutions and foreign investors that are selling treasuries, but that's not what the real issue is that's clogging the system. With the VIX at elevated levels around 50, there is a lot of hedging activity going on, and it could therefore be risk reduction among large asset managers that are managing rates, credit, and equities. And yes, there is strong evidence that people are hedging the downturn of this market because a lot of the professional investors believe we're headed into recession. In fact, the data, when we look at the swap spreads, well, it says that's exactly what's coming. But is that really the issue here? Well, no, that isn't it. And with almost $1 trillion in the basis trade, it could be an unwinding of the basis trade among levered hedge funds. And now we're starting to get to the real root of the problem is that hedge funds have a massive billion-dollar trade in treasuries and they're being forced out of it. But what's the catalyst behind this and why is the White House panicking? Well, let's take a look at what could cause the liquidity crisis that started last week to get even worse. And let's take a look at 10-year swap spreads versus 10-year yields. Now, swap spreads are shown in red and they're inverted here. So when swap spreads go up, yields go down. Now, a lot of people think that this has something to do with the basis trade, but let's understand what swap spreads are telling us. Because when swap spreads went down, what did we see? Interest rates went up. And the popular view was that the bond market was telling us that this was all about inflation. But the swap market was telling us a completely different perspective. It was saying we don't see inflation. In fact, we see that the U.S. economy is headed into a recession. We think financial conditions are tightening, and this is an indication that a liquidity crisis is brewing. Now, did it have anything to do with the tariffs? Well, think about it this way. The U.S. economy is already slowing down, and this escalation in the trade war, all it did was expose what was really a weak U.S. economy and financial system that is on the edge of a cliff. And that's exactly why you saw the White House back off, because we have a former hedge fund manager, Treasury Secretary Scott Bessent, at the helm there of the Treasury. And you know, he came out and told President Trump, look, the moves you're making right now are destabilizing the financial system. We need to back off. The problem they don't realize is the financial system is in far worse shape than they realize. Selling by foreign powers, especially China, is likely, and that's the culprit that everyone thinks is the issue, that China is dumping treasuries to get back at the United States for escalating this trade war. But if we go back over the last couple of years, as I showed in a prior show, what's happening is China's already selling treasury securities. So this is unlikely the issue, and yes, they're probably selling here, but it isn't to destabilize the financial system. It certainly is likely on Friday, as the chart showed, the move in swap spreads or the basis unwind is insufficient to explain the move higher in yields. But here's the issue. It is sufficient to explain it, but a lot of people want to believe otherwise. Why they're pointing that the move higher in yields, lower in bond prices has to do with China, because everyone's trying to link the chart between swap spreads and the basis trade, but there's something they don't understand. The two have nothing to do with each other. So if we understand what's going on with hedge funds, is they're being forced to liquidate a leveraged position in the bond market. So what hedge funds do is called a basis trade, and they exploit the difference between the cash price in treasuries and the futures price. Now, how do they do this? Because, well, the margin in this trade is so thin, they go to the repo market and they borrow massive amounts of money at very low interest rates. Now, the issue that everyone wants to link is that the swap spread chart is what's causing, of course, the panic in the markets and forcing the hedge funds out of this. But that's not actually true at all. What we're seeing in the hedge fund side is that repo providers that put cash into the financial system, that create liquidity, all of a sudden they started panicking. And they did because swap spreads were collapsing, telling them that the risks in the financial system were rising. So what did these repo traders do that put cash in the system? Well, they asked the hedge funds to post some collateral. Of course, in a levered trade like this that relies on cheap money, hedge fund says we can't do it. So what are they forced to do? And that's liquidate en masse. And yes, what we saw last week in the treasury market could be everything to do with hedge funds. And to make sure the yuan doesn't crater, China is actively buying the currency through intermediary banks while selling the dollar. Now, this is a case of why everyone thinks China's dumping treasuries. And yes, China has been selling treasuries, and they're likely to continue to sell treasuries because they need dollars. And that does make sense. And by extension, China is securing the funds it needs to support the currency by selling treasuries it holds in reserve, whether domestically or in Belgium via Euroclear, where it appears that treasury holdings are now where they were just before China devalued the yuan back in 2015 and then further liquidated its treasury holdings. Now, I want you to understand that in a dollar-denominated system, the way you see dollars flowing into other countries is through global trade. Now, when they accumulate too many of them, they turn around and they buy treasury securities, and the dollars get recycled right back to the United States, and the system continues to circulate them all over the world. So when a country is accumulating treasury securities, it means they're building up dollar reserves. So if there's a time when they need them, well, the natural explanation is they're going to go to the market and sell them. We know China does indeed need dollars, but the prevailing view here is they're dumping it to cause chaos in the U.S. financial system. But when we really look at the details, it has everything to do with repo providers who see financial conditions are tightening and are worried about getting their money back on those short-term loans that they provide liquidity to the markets with, causing, again, hedge funds to unwind their position in a big way. That China was liquidating its Euroclear treasury holdings after 2015 yuan devaluation, and you can see it very clearly here. But this doesn't explain the move in the markets at all, because the reason China was selling, because bond prices went up. Now let's take a detailed look at what happened at 10-year treasuries during that same period. And here you can see in yields shown in blue what happened when China devalued. Yields went down. And when yields go down, what does that mean? Bond prices went up. So what did China do? They devalued the yuan, caused interest rates to go down, which meant bond prices went up. So the value of their treasury holdings went up, and they sold into that. That's what China did. And so there's some evidence that that's likely to happen here once again. But the notion they're dumping now ahead of a deval, well, the reality is that if they're going to devalue the yuan, they're going to dump after that when prices are higher. And simply, let's look at China's side. It's clear the central bank is doing everything in its power to prop up the government in its trade war with the U.S. and give the impression that China is not getting crushed by the trade war through such primary indicators as a stock market and its currency. And this makes perfect sense because, yes, they are going to do everything they can to prop up their currency and their economy. It makes perfect sense because they want to hang on. They think they have a chance at winning this, or they believe that something's going to change. They just need to ride it out long enough, and the next thing you know, there's going to be a big negotiation and the whole thing will get quickly settled. But if their economy collapses or their currency collapses, well, it means China's going to have to come groveling to the negotiating table, and that's something Beijing doesn't want to do. But if just the fact that the markets are struggling here doesn't mean you have to. Check out this trade we put onto our Momentum Timer Pro subscribers on the 10th. We told them to buy it open right here, and now in 2 days, it's up over 9%, and you could have been in on this trade. I'm going to show you all the details on it at the end of the show, but if you want to make money trading these markets, grab the links in the description below, use your coupon code for a free 30-day free trial, and find out how my subscribers made 9% in 2 days, and you can too. And surprisingly, the Fed has so far refused to even consider doing the same on the U.S. side. Quite the contrary, as New York Fed President John Williams said, the current rate stance remains appropriate. And this is amusing considering the Fed was jumbo cutting last September when financial conditions were massively looser and when forward inflation expectations were much higher than they are now. And a lot of this is, as I made the claim, the Fed doesn't want to be on the books supporting a trade war or whatever whims an administration does. But the evidence that they should be cutting rates here, well, is pretty convincing because right now financial conditions are tight. We're seeing hedge funds get smashed out of their basis trade, and we know the Fed could come in with QE at any moment and say, look, we're going to buy up these bonds, but instead they're keeping themselves out of the picture. And as one former Fed member said, well, it has everything to do with politics. Former New York Fed President Bill Dudley penned up an op-ed during the peak of the first Trump trade war with China, in which he urged his former Fed colleagues not to stimulate and to crash the economy in order to destroy Trump. So he's saying Fed shouldn't enable Donald Trump. This was back then, and you can better believe the Fed doesn't want to do that now. That's why they're standing pat, saying, look, if inflation goes up, that means we have to keep financial conditions tight to bring it down. But the problem, we keep making this case, is cure for inflation is already more inflation, because U.S. consumers can't afford it now. They're certainly not going to be able to afford it then. And what have we noted in consumer price index this week? We saw disinflation. What happened at the producer level? There was even more disinflation, suggesting that these higher prices cannot be passed on. But let's take a deeper look now what JP Morgan is suggesting could cause this liquidity crisis to go all out. Deleveraging and deterioration of macro sentiment, that means the broad U.S. economy, has morphed into a situation in which liquidity dynamics are now meaningfully impaired in liquid markets. The lack of liquidity could result in price moves that are outsized, in which we saw last week, relative to the amount of flow that's actually going through. This is in both directions. Significant bounces can take place on air, while it could similarly lead to an unruly market outcomes to the downside. But she concludes the deterioration of the broader liquidity framework is never a great setup for risk markets, suggesting is we are in the midst of liquidity crisis and it could get worse. And while trade headlines might drive markets up for a day or even for a few hours, that what's going on underneath the plumbing of the financial markets, we're seeing signs it's clogged, it's fracturing, and there's nothing so far on the horizon that suggests it could change. And Boston Fed President Susan Collins said on Friday that the central bank would absolutely be prepared to help stabilize financial markets if conditions became disorderly. Markets are continuing to function well, she said, and we're not seeing liquidity concerns overall. Well, yet JP Morgan sounding the alarm very clearly here to say, look, there are issues with the plumbing of the financial system. This shouldn't be happening. And what we're seeing just by these tariff headlines is that the U.S. financial system is in a dangerous state, that anything could push it over the edge. And right now you're seeing why the White House is scrambling at the top here to reverse some of these tariff moves, because they believe that's what the catalyst is. Well, it might be what's pushing or nudging the U.S. economy and financial system into an abyss, but it isn't the real reason why. Let's take a look at what Trump responded as he floated a possible exception to the 10% baseline tariff. On Friday, he said, I think the markets were solid today. I think people are seeing we're in a great shape. And he insisted that the U.S. dollar would always remain the currency of choice. Now, the question is, will it always be that? I'm not sure about that. But for the time being, there are no alternatives to the dollar, so it will stay in place no matter what happens. If a nation said we're not going to be on the dollar, I would tell you that within about a phone call, they'd be back on the dollar. You always have to keep the dollar. Well, that is until something else eventually replaces it. The exclusions published last Friday by the U.S. Customs and Border Protection now narrow the scope of the levies by excluding the products from Trump's 125% China tariff and its baseline 10% global tariff on nearly all countries, indicating that the White House here is indeed panicking. They're well aware that the financial system is breaking. They don't want to be the catalyst and have tariffs be the reason that we see more bank failures or the whole system seize up and we find out that interest rates surge higher or the stock prices crash or some other devastating thing that impacts the financial markets. These exclusions would apply to smartphones, laptop computers, hard drives, and computer processors, and memory chips as well. Those popular consumer electronics items generally aren't made in the U.S., and setting up domestic manufacturing would take years, and this is something we've even seen in other industries saying, look, we're just going to have to weather the tariffs here because it would take 5 to 10 years for us to build factories and move production to the U.S. Many believe that this tariff battle will not even go anywhere near that long. And yet the U.S. economy is facing an air pocket, and that's what the financial system and swap spreads are trying to tell us, as imports at busiest U.S. ports are set to drop in the next month as tariffs hit. We can see a drop-off in volume starting as early as the month of May, according to the executive director of the Port of Los Angeles. At the very least, the gateway will see a 10% drop in imports in the second half of the year. Now keep in mind, what is this going to impact? Jobs, hours, everything. So a 10% decline in, of course, imports means there's a lot of people that are going to either be on the unemployment line or see their income shrink. And this is a problem right now with rising inflation. Consumers can't afford anything that causes their pay to go down. And now U.S. economists are bracing for a sharp slowdown despite Trump's pivot. On Friday, Federal Reserve Bank of New York President John Williams said he expects, quote, real GDP growth will slow considerably from last year's pace, likely somewhere below 1%, suggesting the U.S. economy is indeed headed into a recession, which is exactly what swap spreads are saying. So while the market is again saying, look, interest rates need to go up, look what happens when the hedge funds are getting blown up, swap spreads continue to say the U.S. economy is slowing down, headed right into recession, and now the Fed is validating that. The unemployment rate is set to climb to somewhere between 4.5% to 5% over next year from 4.2% in March, and inflation will rise to 3.5% or 4%. So at the same time, what is the Fed telling us here? We're going to see stagflation, which is rising consumer prices and rising unemployment. We're headed right into a recession. All the data is pointing to this, and the financial markets, this lack of liquidity, is validating it. Those numbers suggest as projections are in line with the latest consensus and estimates among Wall Street forecasters. And yes, everybody's saying the U.S. economy is headed to the downside. Will anything close to these tariffs and this uncertainty persist for long? Well, if yes, we would be forecasting a U.S. recession. But again, we talk about, this is what swap spreads are saying. This is what everybody's pointing to, is the U.S. economy is heading to recession because there's so much uncertainty about this trade war that all it's doing is exposing the weakness of the U.S. economy and our financial system. Because unless this is dealt with and soon, businesses don't know what to do because things are changing on a daily and weekly basis. Consumers don't know what to do either. So what's going to happen is consumers are going to start tightening up their belts. They're going to spend less. They're going to save more. And that means, of course, businesses who have massive amounts of inventory right now are going to see less sales, less demand. It means, of course, they're going to have to cut staff. And this is going to backflow all the way up to the manufacturing level. And next thing you know, the U.S. economy is going to be right into a recession. At this point, we're still leaning on a series of quarters of sub 1% GDP growth, and it makes perfect sense by all the data we're seeing. And Fed's William joins the growing Fed chorus saying rates are on hold for now. And while uncertainty about the economic outlook reflects many factors, the effects of tariffs and trade policy on the economy are certainly on the top of the list. And we've seen uncertainty at the CEO level. They've come out and said, look, we're not sure what to do here. Small businesses that were super optimistic after the election, now their optimism is plunging. And what did we just see from the University of Michigan Consumer Confidence Survey? The confidence among consumers is falling. Their outlook over the next 6 months, plunging to the lowest level since 1980, has everything to do about finances, their job, and their outlook if they lose their job and their ability to get another one. And right now, consumers are saying, look, we believe this trade war is going to impact us financially, and that means they're going to react accordingly. And as people tighten up and they stop participating in the markets, this liquidity crisis that's brewing last week is set to get even worse. And that means, of course, what JP Morgan is worrying about and trying to tell the Fed and the Trump administration is, look, Fed, you need to step in here. Trump, you need to get this trade war over and fast, because what's happening is something we don't think can stop. But just because the trade war is causing a liquidity crisis doesn't mean it has to impact your trading account. Let's check out this trade we put back on the 10th of GDXJ. That's junior miners. We told our subscribers to buy it open. Here was the notes on 410. Buy it open. We gave them an upside target, which we blasted right through, and a stop loss level. That trade now up 9.78% as the close of business on Friday. Here you can see the chart. We said buy right here and took off just like a rocket. And you can grab our next big trade too, because every day we take a look at momentum across the broad equity, bond, currency, and commodity markets, and we look at it over multiple time scales. But we do something very unique, because while most traders just look at, say, an RSI, the MACD, or other technical indicators, we aggregate them together. But the problem is, in a downward trend, something can be oversold, triggering a buy signal, meaning if price continues to fall, that signal was invalidated. So what we do is we overlay the trend with momentum, and that gives us the edge. And that shows up on our hot list every day, along with the fact that you get all of the data across all of the securities, but you get the daily report. You get all the tradable signals, including on the hot list, and I review every trade and give you my opinions on which ones I think you should take. I give you risk control levels, a full tracking of all of our open trades and returns, a weekend update, disclosure on how I'm trading my book, and here's the most important part. You don't even have to put 1 penny out to try a report, and we do that because we're so confident you can make money trading. We want your first 30 days to be on me. Grab the links in the description below. Use the coupon code for your free 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.